Usually when we look at the dividend yield from a standard index fund, say something hovering around 1.5%, it feels a bit like watching paint dry.
Yeah, it really does.
Right. I mean, it is reliable, sure, but it is not exactly thrilling for you. But then you step into the world of covered call ETFs, and suddenly you are seeing yields of 10%, 11%, even 12%.
Which is massive.
Exactly. And after that brutal 2022 bear market, when everyone was just starving for steady income, looking at a 12% yield feels like finding a glowing treasure chest right in the middle of a desert. You just want to grab it.
It is entirely mesmerizing. I mean, I get the appeal completely. But Wall Street does not leave 12% yields lying in the desert for free.
No, they definitely don't.
Right. That treasure chest is often a mirage.
Mm.
Not that these yields are fake. I mean, they are very real cash hitting your account. But the true cost of that payout is completely invisible to the average investor until it is too late.
Which is exactly why we are opening up the engine room of covered call ETFs today.
Well,
We really need to find out exactly what you are trading away to get that massive payout.
we do.
We are pulling from a massive stack of sources for this deep dive today, ranging from analytics over at Motley Fool and Days to expiry, to academic research from Thomas Jezzo's thesis, and some incredibly dense tax literature from Tap Alpha.
Yeah, it is a dense stack, yeah. But the fundamental trade-off we are going to explore today really boils down to one simple concept.
Okay.
These funds are trading your potential long-term stock market gains for higher immediate income. It is a contractual exchange, not some magic trick.
Okay, let's unpack this, because if I am getting 11% when the rest of the market gets barely 1.5, what exactly is happening mechanically? Like, how do these funds actually generate that cash?
Well, it all comes down to the mechanics of the covered call strategy. At its core, the fund is doing two things simultaneously.
Okay, what's the first?
First, it holds a basket of stocks. So maybe the S&P 500 or the NASDAQ 100. That is the covered part of the name.
Yeah.
You own the underlying assets.
Right, you actually hold the stocks.
Exactly. And second, the fund sells call options against those exact stocks. By selling these options, the fund collects an upfront cash payment from the buyer.
Got it.
That payment is called a premium, and that premium is what gets passed on to you as that double-digit yield.
You know, I think the best way to visualize this for you listening is through real estate.
Oh, yeah, that's a great way to look at it.
Imagine you own a house in a booming neighborhood. You sign a binding legal contract today that says you agree to sell that house to someone next month for a set price, let's say $500,000.
Okay.
In exchange for signing that contract, the buyer hands you a huge upfront cash payment right now.
Right, the premium.
Exactly. Now, if home values suddenly skyrocket and your house is worth $600,000 next month, well, you miss out on that boom.
Because you are legally obligated to sell it for $500,000.
Right. But if the housing prices stay flat or even drop, you keep your house, the contract expires worthless, and you keep that fat stack of cash they gave you.
That analogy hits the exact mechanism. You are taking on a contractual obligation. And what is fascinating here is how often investors misunderstand that upfront cash.
How so?
The biggest misconception in this space is that option premiums are just like free yield generated out of thin air. They aren't.
Yeah.
Structurally, a covered call is long equity exposure mixed with short volatility exposure. You are quite literally selling away your right to future upside.
You are hitting a glass ceiling, upside capping.
Exactly, upside capping. The ultimate risk here isn't just that the market might crash. I mean, if the market crashes, you still lose money on the underlying stocks.
Though the option premium you collected does cushion the fall slightly, right?
It does, slightly. But the real hidden risk is missing out on massive bull runs.
Yeah.
You suffer all the gravity of a market drop, but your growth is artificially capped on the way up.
So, knowing that upside is the ultimate sacrifice here, instead of just reading down a list of funds, let's look at how the top 5 standouts from our sources actually structure this sacrifice.
That makes
We selected these based on their historical performance, but more importantly, their entirely different strategies. Let's start with the cautionary tale of the blind at the money strategy. That is QYLD, the Global X NASDAQ 100 Fund.
QYLD is a really fascinating starting point because it has been around for over 10 years. It boasts a massive 10 to 12% yield.
Right.
But over that decade, it has only returned 8.79% annualized. Why the disconnect? Because QYLD blindly sells at the money calls on 100% of his portfolio every single month.
Meaning the strike price, like the price they agree to sell the stocks at, is exactly where the stock is right now.
Exactly.
There is zero room for the asset to grow before that cap kicks in.
Zero room. It
Yeah.
caps 100% of the upside. If the NASDAQ surges 10% in a month, you capture exactly none of it. You just get your premium. Over time, in a market that historically goes up, that strategy completely erodes your total wealth. You are eating all the downside volatility and capturing none of the recovery.
Which naturally pushes investors toward funds that actually let the stocks breathe a little bit.
Yeah.
That brings us to the out-of-the-money indexers.
Right, the heavyweights.
Yeah, the heavyweights here are JEPI and JEPQ from JP Morgan. JEPQ tracks the NASDAQ 100 and has delivered a massive 24.14% annualized return over the last 3 years with an 11.58% yield.
That is huge.
It is. And JPI does the same for the S&P 500, holding $42 billion in assets, yielding over 8% with a 9.41% 5-year return.
And both charge a very low 0.35% expense ratio.
Right. But the sources point out they use something called equity-linked notes, or ELNs, to generate this income. Wait, equity-linked notes? We can't just drop a term like that. How is an ELN different from just selling a normal option contract?
That is a crucial distinction. When a fund has $42 billion in assets like JPI, going into the open market and manually writing thousands of individual option contracts every week is
A logistical nightmare.
a total logistical nightmare. It's incredibly inefficient. So instead of trading the options directly, JP Morgan uses ELNs.
Okay, so what is that exactly?
An ELN is essentially a custom-built debt instrument. It's a bond issued by another major bank that is mathematically designed to perfectly mimic the payout of a covered call strategy.
So the fund essentially pays another bank to do the dirty work of trading the options, and the bank just hands the fund the resulting cash profile.
Precisely. It allows massive scale and keeps their internal trading costs incredibly low, which is exactly how they maintain that low 0.35% fee.
Okay, that makes sense.
However, it introduces something called counterparty risk. You are relying on that issuing bank to make good on the note.
So if the bank issuing the ELN goes under...
That note could become worthless, completely regardless of what the stock market is doing. It is a small risk with major institutions, obviously, but it is a structural difference you absolutely have to be aware of.
Okay, so if you don't want ELNs and you want direct option trading, we have to look at our fourth fund, which is SPYI, the NEO's S&P 500 High Income ETF.
Yes, a newer player.
Right. This one launched in early 2024, annualized 19.84% since inception, and sits at an 11.6% yield.
And they do it differently.
Yeah, it actively manages its options overlay using actual SPX index options, not ELNs. But I have to push back here.
Okay, go ahead.
Look at the fees. SPYI charges 0.68%. That is practically double JPI and JEPQ's 0.35%. Is avoiding ELNs really worth paying double the management fee?
On the surface, it looks steep. I agree. But to answer that, we have to look at the tax efficiency of the specific options SPYI is trading.
Okay.
SPYI uses what the IRS classifies as Section 1256 contracts.
I have seen this pop up in the tax literature. What exactly makes a 1256 contract special?
Well, under the U.S. tax code, any gain or loss on a Section 1256 contract is treated as 60% long-term capital gains and 40% short-term capital gains.
Okay.
And here's the kicker. That 60-40 split applies regardless of how long you actually held the contract.
Wait, really?
Yes. Even if the fund trades options weekly or monthly, 60% of that income is taxed at the much lower, highly favorable long-term capital gains rate.
Oh, wow. So for an investor in a high-income tax bracket who is holding this in a regular taxable brokerage account, that massive tax break on the distributions could easily pay for that extra 0.33% in management fees.
Exactly. It's a structural advantage built specifically for taxable accounts. Plus, SPYI writes options out of the money, meaning they set the strike price higher than the current market value.
Giving the underlying S&P 500 stocks room to grow before the cap kicks in.
Precise.
Which brings us to a totally different strategy. What if you don't want to write options on a whole index at all? That is our fifth standout, DEVO, the Amplify CWP Enhanced Dividend Income ETF.
DEVO is a very interesting one.
Yeah, 5-year annualized return of 12.07%, but the yield is much lower, around 4.5 to 5%.
That's because DEVO takes a surgical approach. Instead of blindly writing options on everything, it holds a highly concentrated portfolio of just 25 to 30 blue-chip dividend stocks.
Okay.
The managers handpick individual stocks to write calls on based on momentum and volatility, so it is highly tactical.
So they might write calls on Apple this month to generate income, but they intentionally leave Microsoft completely uncapped because their analysts think Microsoft is about to have a massive breakout quarter.
That is exactly it. They only write calls on a handful of their positions at any given time.
Right.
You sacrifice that eye-popping 12% yield, but in exchange, you preserve far more of your total return potential because most of your portfolio is allowed to run free.
I love that contrast. But let's put these strategies to the ultimate test. Those double-digit yields sound incredible on a fact sheet, but how does this actually translate to wealth building if you reinvest those dividends?
The DRIP scenario.
Yeah, if you drip them back into the fund over a whole decade.
The days to expiry analytics provided a brilliant 10-year simulation that completely shatters the illusion of high yield. Let's look at a $100,000 investment over 10 years.
Okay, I'm following.
First, imagine you put that $100,000 into JPI, which uses weekly options and yield roughly 9%. Over 10 years, it generates an impressive $90,000 in raw income.
That sounds fantastic. You've almost doubled your money just in cash flow.
It does sound fantastic, but here's the catch. Because it sells options weekly, it constantly aggressively caps its upside during market rallies.
Right. The glass ceiling again.
Every single week, it is hitting that glass ceiling. So your base capital only grows from $100,000 to $130,000.
Wow, that's not much growth.
No. Your total wealth is $220,000. Now, assume you are in a taxable account paying ordinary income rates, say 40% on those distributions.
Okay, doing the math.
Your after-tax wealth drops to $158,000.
Okay, now let's compare that to XYLD, which sells monthly calls on the S&P 500 instead of weekly and yields a significantly lower 7%.
With a 7% yield, XYLD generates $70,000 in income over that decade.
Which is $20,000 less income than JEPI.
Right. However, because monthly calls give the underlying stocks 4 full weeks to breathe and capture more than market's upside before the cap resets, your base capital grows to $180,000.
Wow. Total wealth, $250,000.
Exactly. Furthermore, because monthly transactions create fewer taxable events than weekly trading, your tax rate on those distributions might be closer to 25%.
So your after-tax wealth.
$206,000.
Here is where it gets really interesting. So, wait. The fund with the lower yield generated $48,000 more in total wealth over 10 years. That is a staggering difference.
It really is.
It proves that high yield, when combined with high tax drag and aggressively capped upside from weekly trading, is an absolute wealth killer over the long run.
The math doesn't lie. If we connect this to the bigger picture, this proves that account placement strategy is everything. You have to be strategic.
Yeah.
If you are absolutely determined to use highly taxed weekly call funds like JPI, they belong in a tax-advantaged account like a Roth IRA, where that income can compound tax-free.
Right.
But if you are investing in a taxable brokerage account, you should strongly lean toward monthly, tax-efficient funds like SPYI or XYLD.
But if these funds are known wealth killers over a decade compared to just holding the S&P 500, why are analysts suddenly forecasting them as the ultimate retirement tools? Like, what changed in the market?
What changed is the investor appetite for volatility. Analysts see these transitioning from niche tactical tools to core retirement holdings because retirees prioritize smooth, predictable cash flow over maximizing terminal wealth.
That makes sense for retirees.
Yes. However, we have to look at the academic data, specifically from Tomás Jezó's thesis. His research proved that in a strong, persisting bull market, covered calls will virtually always underperform standard index funds.
Because the math of option pricing requires chaos to be profitable, right?
Exactly. The success of these funds relies entirely on the volatility premium. When the market gets choppy and investors panic, option premiums, which is basically the price of that financial insurance, skyrocketing.
Right.
For covered calls to win, the implied volatility, which dictates the upfront cash they collect, must remain consistently higher than the realized volatility of the actual market movements.
So if the market just marches steadily upward without much fear or chop, premiums dry up, the funds collect very little cash, but they still cap their upside. They lose the math game.
They absolutely do.
And there is another piece of dark math we have to talk about. The TEP Alpha literature brought up SEC Rule 19b1 and a concept called return of capital, or ROC.
Yes, ROC.
How does a fund yielding 12% actually sustain that payout if the market is calm and premiums dry up?
This is a crucial, widely misunderstood mechanism. Under U.S. tax law, the income generated from selling options is not legally considered investment income.
Wait, really?
Really. Only traditional dividends and interest count. And SEC Rule 19b-1 strictly limits how often an ETF can distribute long-term capital gains to its shareholders.
But these funds pay out monthly. If the options money doesn't legally count as income, and the SEC limits capital gains payouts, how are they cutting a check every 30 days?
They use return of capital. To maintain those high, consistent monthly payouts that investors demand, the fund will classify a portion of the distribution as ROC.
Okay, so what does this all mean for you as the listener? I think I know how this works. Return of capital is essentially the fund tearing down the guest bedroom of your house and selling the lumber to pay your own mortgage.
Yeah.
Right. Sure, you have cash in your hand this month and you feel like you got paid, but your overall house is literally getting smaller. You are just getting your own principal handed back to you.
That is a brilliant way to conceptualize the erosion of net asset value. Now, ROC isn't purely evil in all contexts.
Yeah.
No, it has a specific tax benefit. It lowers your cost basis and defers taxes until you finally sell the fund. But, and this is the critical distinction you have to ask, is the fund actually making enough total return to cover that payout?
Right.
Because if the total return of the fund doesn't support the massive size of that monthly distribution, the ROC will slowly eat away at the fund's net asset value over time.
The NAV.
Right? Your principal shrinks, which means next month there are fewer assets to write options against.
Which means less premium.
Exactly, which leads to a downward spiral of wealth destruction.
Right. If your house is slowly sinking into the mud, it doesn't matter how pretty the front door is, you have to ensure the total return matches or beats the payout.
Yeah.
Which is why, at tax time, investors get Form 19A1 in the mail. We really need to clarify this because it is easy to confuse with the SEC rule we just talked about.
Yes, very easy to confuse.
Right. Rule 19B1 is the law capping the gains distributions. But Form 19A1 is the actual notice the fund sends you, detailing exactly how much of your monthly check was just your own money being handed back to you as return of capital.
Exactly. You must read your 19A1 notices. They are the canary in the coal mine for NAV erosion.
So bringing all this complex data, all these mechanisms and option strategies back down to earth for your personal portfolio, let's summarize the landscape.
Well, if your primary goal is maximum income right this second, maybe you are fully retired, you don't care about 10-year growth, and you just need the cash flow to pay bills today, the high-yield, ELN-driven funds like JPI might be the ticket. They maximize the upfront cash.
But if you want a balance of growth and income and you don't want to completely sacrifice your future capital to a glass ceiling, you should look at tactical funds like DIVE or monthly tax-optimized funds like SPYI. You just absolutely must pay attention to the tax implications and whether the fund is suffocating its assets with weekly expirations or letting them breathe with monthly expirations.
The ultimate takeaway from all these sources is that total return is the only metric that truly builds wealth. The academic research actually highlights a fascinating psychological trap here called hedonic framing and mental accounting bias.
Is this just a psychological trick we play on ourselves?
Very much.
Like, we see cash hitting our checking account and it feels like a win, so we intentionally ignore the fact that the actual stock price is bleeding out.
That is precisely what it is. It is the human tendency to mentally separate our money into different buckets. We view income, the tangible monthly cash hitting our account, as safe, real, and positive.
Okay.
And we view capital gains, the fluctuating value of the ETF itself, as risky, abstract, or imaginary.
Wow.
Because of this mental accounting bias, getting a 12% yield feels incredibly rewarding on a neurological level, even if the underlying asset is quietly depreciating and making you poorer.
We get addicted to the monthly dopamine hit of the dividend notification on our phones. It feels like we beat the system. So I will leave you to examine your own portfolio with this thought.
It's a good one to ponder.
Are you chasing a 12% yield just because it feels good to get a monthly check? Are you secretly sacrificing 20% of your invisible long-term wealth just to get that feeling?
It is a sobering question, and it requires looking past the flashy yield percentage to understand exactly what contractual upside you're trading away to get it.
Take a close look at those 19A1 tax forms. Keep digging into the mechanics of implied volatility and those out-of-the-money strike prices.
Highly recommend that.
Because if you just stare at the glowing treasure chest of a double-digit yield, you might completely miss the fact that it is sitting in a desert of capped growth. Thank you for joining us for another deep dive, and we'll see you next time.